Capex and Depreciation. So this part will be actually one of the most difficult one in modeling, in financial modeling. And this is actually due to the fact that when it comes to assets, there are like three things that we will have to track. So there is the gross book value. So this is the price at which we bought the specific asset. Then the depreciation, so the cost or the part of the gross book value that was accounted to cost in a specific moment. And then the net book value, so how much is, according obviously to books, certain specific asset worth. What is the relation between those three assets? It's basically the gross book value minus the sum of all depreciation done for a specific asset gives us the net book value of this asset. What matters is also that we actually have to track each and every asset separately. What happens is that for the modeling purposes, we don't do it. So we do actually tracking, but on a group level. So we have those groups of fixed assets. So in our case, it will be intangibles, buildings, machinery, transportation equipment, and other. And each and one of them will have a separate sheet where you model the gross book value, depreciation for specific period, and then also you calculate on the basis of this the net book value. Then what happens is you get the capex, which feeds into those sheets and gives you new assets to be depreciated and new assets that you have to calculate the net book value of. And then in order to have it fast transformed into P&L and balance sheet positions, you put it in a separate sheet which summarizes everything, which will be called FA summary. And from this sheet, the data lands in profit and loss and balance sheet. So the P&L gets the depreciation for a specific period, and then the net book value goes to the balance sheet where it shows how much currently assets are worth. So let's have a look how it looks in Excel sheet. So here we've got the capex. As you can see, we've got the positions here. So every category there's a special row, and then by years. We'll assume that for the purpose of our model, we're gonna do just the so-called renovation investment. So we will just renovate what was lost, and this will be equal to the amortization from previous periods. The FA summary looks like this. So we've got gross book value by groups, depreciation by groups, and net book value by groups. And for every group of products, we will do the tracking. As we said, we're going to do it by groups, but also we have to track it by time at which they arrive in the company. So we're actually going to do the tracking by years. So actually in this row, we're going to have only intangible assets bought or put into the books in 2015 or earlier, then 2016, 2017, and so on and so forth. And each and one of them we're going to treat as a separate category of assets, and this we do for every group, as you can see here. We're gonna do two with you, so intangible and machinery. So on the basis of this, you should do the rest of them in order to get some practice. And as I said, this is the most difficult part when it comes to the profit loss account, and probably in the modeling one as well. Let's start with modeling the intangibles. So as you can see, we have the gross book value that has to be modeled, depreciation, and net book value. The gross book value stays the same over the whole period, but obviously we have to have the new investments here, because we just have here the investment from 2015 and earlier. So here the new investments will be coming from the capex. So we go to capex, and then we look for the intangibles. We block raw because we will want to use this for each and every year, and since they will be implemented in the no earlier than the year in which they occur, we just put it on the diagonal, as you can see here. So 2016, 2017, 2018, and so on and so forth. And as I said in the previous example, it will always be equal to the beginning value. Here we've got 0 because we don't have the amortization, but we're gonna change it in a minute. And let's say erase this. Okay, so this is the gross book value. So the depreciation in a specific year is equal to the depreciation rate multiplied by the book value of the specific asset. And again, we do it by years. So I take this one. For the first one, obviously we have to block for the column E. Yes, and then we have it here, for example, the depreciation. Obviously the problem is that you cannot go when it comes to depreciation below the net value. So this, whatever we've got here, should not be higher than what we've got, but you're going to see the problem in a minute. So let's also have a look at the net value. So net book value is equal to a net book value from the previous period minus depreciation for this period. And as you can see here, the net book value is 2.3, whereas the depreciation is equal to 34.5. So what we have to do here is make the minimum condition stating that the depreciation cannot be higher than the net book value. So we take the minimum out of the depreciation we calculated in the simple manner and the net book value from the previous period. And as you can see, what will happen here is once we get the book value is we totally depreciated the assets which we bought in 2015. So they were worth by gross book value 172, but we have almost depleted them. So after 2018, they're basically, we don't see them in the books. So physically we've got them, but in books they don't exist. Now what happens is we also have to calculate the depreciation for the things which were bought in a specific year for this year. So we could probably use this formula. The only problem is that those things will appear later. So they sometimes appear in the first half, sometimes in the second half. So as a simplification, we assume that we will be depreciating them only half of the time. And this will happen only on the diagonal. So again, I go like this. And for the rest, we've got the value which we have calculated previously. And this should roughly work. When it comes to the net book value, again, on the diagonal, there will be a bit different formula because we have to calculate the net book value without previous net book value. So actually we do it from the gross book value. So for the first period, when certain asset appears, the net book value is equal to the gross book value minus the depreciation in a specific period. And again, this only counts for the diagonal. So I go like this. For the rest, obviously, I take the net book value, as in the previous example, from a previous period. And we just remove depreciation from the period we are talking about. We also have to get rid of this. And as you can see, we have managed to calculate the book value, the gross book value, depreciation, and the net book value of each and every asset. As you can see, here we've got the new asset, the gross book value, and here the depreciation calculated for them. If you look at from the raw perspective, this shows you the evolution of a specific asset bought in a specific year. So this, for example, is the evolution of the assets bought in 2017. So the net book value was 33.5 in the 2017, then 26, 18, etc., and they were totally depleted in 2022. So as you can see, the net book value, thanks to renovation investment we are doing, is roughly on the same level after obviously the first few years where we have catch up period, but then they roughly are around 40 something, 50,000. Once we are done with the intangibles, we can easily copy this to the machinery and each and every other type of assets. So let's do it together for machinery, and then you will do it on your own for buildings, transport equipment, and other assets. So for machinery, you just go and copy the formulas for every category. So first for the gross book value, then you do it for depreciation. They're almost the same. We'll just have to change them in one place, and then also for the net book value. Difference obviously will be coming from the capex. So here, when you look on the diagonal, we've got the capex from row 8, which is the intangibles. And what we want to do is change it to equipment and machinery, which is the row 11. So the easiest way to change it is basically to go here to the address, change it to 11, and then copy this on the diagonal. So the places where we've got the new investments introduced. We are almost done. The only thing we have to do now is to increase the capex. So as we said, in most cases we do the just renovation investment, whereas for the machinery in 2018 we want to do additional investment of a new capex of 2 million. So I'll just add it here. Obviously I can also do it as a separate row. So now, as you can see, we've got all the values here. In the same manner, do it for buildings, transport equipment, and others. And once you finish this in the sheet FA summary, you will have all the data you need, and then we'll feed it into the profit and loss account. So do it on your own, and then we will continue with ready-made files. Hopefully you managed to do all sheets, FA intangible, FA machinery we did together. You should have done FA buildings, transportation, and FA others. Now, once you're done with it, you will have the summary in FA summary sheet. And what we will have to do now is to feed this into the profit and loss account. As you can see, we have 3 values here. So the gross book value, depreciation, and net book value. For the profit and loss account, we take the total of the depreciation. So everything which was depreciated, it becomes a cost in a specific period. So in our case, we'll be simply feeding the data from the FA summary to P&L. So we take this and we drag it. So in this way, we have already full profit and loss account, and we can continue on preparing first working capital sheets, and then on the basis of this and what we have done for the assets, create the balance of sheet. If you had any problems with assembling the sheets, go to financial model after all fixed assets, which is attached to this lecture, and have a look at each and every sheet.